Are you or someone you know looking to buy or sell a home? When you use a HomeGain Realtor to buy or sell a home, you can get $150. Visit HomeGain.com and click on the Promo 150 banner at the top of the page to get started. Compare HomeGain Realtors and choose your favorite. Complete your home purchase or sale transaction with a HomeGain Realtor, and HomeGain will pay you $150. Get started today by going to HomeGain.com.
Welcome back, everyone, to Real Estate 360 Live. I'm your host, Ryan Sloper, joined today by my guest, Louis Cammarosano, the general manager of HomeGain. Quick reminder, Real Estate 360 is designed to build the Washington, D.C. Metro's housing and credit markets one house at a time, but giving you good, free advice. If you ever have any questions, concerns, or real estate needs, the best number to reach out to us is 877-245-2030. That's 877-245-2030, or you can visit us via the web at realestate360live.com. That's realestate360live.com, and that's the place you can go. Like if you have any questions regarding getting your credit fixed to potentially buy a home, if you're looking for mortgage options, you're trying to get financing to buy a home or refinance your home, we can point you in the right direction, as well as all of your home selling and buying needs. Again, that number is 877-245-2030. So before we went to break, we started discussing the Fed's meeting, where last week they had actually issued their minutes from that meeting, and the mortgage markets last Thursday afternoon sold off big time. And this happened shortly after the Federal Reserve at the 2 p.m. released its December Federal Reserve meeting minutes. In their minutes, as Louis discussed in the previous segment, Fed members acknowledged the expanding of the U.S. economy and noted that stimulus programs may not be warranted deep into 2013, which I don't understand because there's really no indicators of employment situation turning around. Yes, has housing turned around in many metropolitan areas? Sure it has. But is that the only indicator they're going off of, is just metropolitan areas where, it seems like the housing markets are picking up? One of the programs which would terminate is the Federal Reserve's third round of quantitative easing, which is known as QE3, which we discussed, ad nauseum on this show. Wall Street did not expect this headline. So basically, everybody started selling off mortgage-backed securities and bonds and started buying stocks. This is almost like a panic move, I guess, by the markets, because they didn't, obviously they didn't expect for this to happen. Louis, it might be like you said, it was probably maybe trying to give signs to Wall Street that things are getting better, although they're really not. And
if you think about it, Ryan, the reason people panic when they sell is they understand the only reason that they own mortgage-backed securities or Treasury bonds is of the perceived safety that the Fed will always buy them, not because of the underlying security and creditworthiness of those securities is good. It's because it's only good because the full faith and credit of the United States is backed by the fact that the Fed will always print up money to pay principal and interest.
Absolutely. Yeah, and, for those of you that are...
When they indicate maybe they're not going to be around to do it, you run out of Dodge because you're not even getting paid any interest to even take the risk.
Right.
And that's what would happen if the Fed decided not to purchase anymore. The interest rates would spike up, and the United States would have an enormous borrowing cost for its enormous amount of spending, and that would lead to a collapse, and you'd have deflation. You'd have all the horrors that they're trying to avoid with this printing scheme.
Well, to put it simply, Louis, this is my thoughts. If the Fed stops buying mortgage-backed securities, if they stopped injecting somewhere close to $40 billion of monthly mortgage bonds, we would have an all-out depression almost immediately.
Correct.
Okay, that's pretty much what would happen, and that's
there is no underlying economy other than what the Fed is doing.
Absolutely, and it's scary to think that they have so much manipulation over markets that could be the case.
Right, but they create a fake market, and they can destroy a fake market just as easily as they create fake money.
Right. I mean, where should real interest rates be right now? And I'm going to use, obviously, I'm going to have us make some other predictions for what we think is going to happen in 2013. But where would interest rates be without the Fed? I mean, what are your thoughts? Where do you think interest rates
I don't know, because I know they would be market driven.
Yeah.
They'd be based on the available credit. They'd be based on the signals that the market is sending to entrepreneurs as to whether they should be investing money or they shouldn't be. I mean, right now, after a housing crash like we had of enormous proportions, we normally would be in a deflationary environment because people would be deleveraging and they would not be looking to invest money.
Yeah, and having said all that, Lewis, my thoughts are, okay, so we basically know that the bank's guidelines to lend money are so stringent right now. In order for it to make sense for the bank and for them to be able to say that, hey, this makes sense because we're taking on this amount of risk, but we're getting this return for that risk, right? They're not going to take a risk at 3% interest rates, okay? So I'm willing to go out there and say if the Fed's not buying these mortgage-backed securities, the interest rates would be double where they're at right now. At minimum.
They have to be.
They would have to be. That 6%, that 6 to 7% range makes a lot more sense for banks. I have a feeling what you would see, and this is why I have a feeling that the Fed has no clue, Congress has no clue, because it's not the worst thing in the world for interest rates to actually rise, okay? Because it could be good because then what's actually happening is you have more of a normal environment, not a Fed-driven, artificially manipulated interest rate market, which
you have a naturally stabilizing economy.
Right. I mean, we want to see where home prices would actually sit with normal interest rates, not artificially manipulated interest rates, because that's inducing more people to buy. So, okay, that's great. The people that can take advantage of it right now, well, there's not that many people that can because it's basically people that have a lot of equity in their house right now that can sell, and first-time home buyers. But people that are upside down or owe more on their property than it's currently worth, they're stuck. There's not a program out there to help them.
Right, and you want an economy where the housing market is reflective of the strength or the health of the economy, not one where they try to boost it artificially to make it the economy.
Yeah, it's like, okay, I guess we don't have the economy is not good enough right now for people to be able to obtain a mortgage.
We might as well try to force people to buy houses by making interest rates so attractive that they're going to take on debt and buy a house, even if maybe they can't afford it. But that's backfired on them because you point out the banks aren't in that game. They're not going to lend to you if you really don't have the ability to make your payments anymore.
Yeah, the banks are like, whoa, okay, Fed, we see what you're doing here. You're basically making this business, not as lucrative for us as it once was. But they're smart, okay? All they're going to do is all of the banks are going to get together. They're going to say, look, we've got these hard costs too. Let's just all agree to keep our interest rates, a percent higher than where they actually should be so we can clear more profit, front-end profit, not, what the actual interest rate is, but that front-end profit that they're yielding off of those higher rates because they got to make money. And
look at it this way. Why are the banks doing so well if what you're saying they're not lending money? Because they're making it elsewhere. They're strengthening their balance sheets by all this free money. They're making it in trading. They're not making it, and they're also making it by not dumping their bad loans onto the market.
It's interesting, Lewis, because Bank of America just reached a $10.3 billion settlement with Fannie Mae. Okay? Now, I believe $3.55 billion of that was in cash to Fannie as a part of the deal, but it's also going to repurchase 30,000 questionable mortgages that they are likely to produce losses, paying Fannie another $6.75 billion for those loans.
Those were trading almost, isn't it? I mean, they're basically one bails out the bank, they bail out Freddie Mac, and they're government entities, and they're just passing money between themselves.
Well, yeah, but the worst part about this is that they basically, Bank of America had basically sold about $1.4 trillion of worthless loans to Fannie Mae anyway, right? So that's a lot of loans, and they made profit on those loans, okay? But yet now they're settling for only $10 billion. Where's the penalty? $10 billion is nothing to Bank of America. You know what I mean? So they know that Fannie Mae, or also known as the government, is not trying to shut down Bank of America. They're just trying to make it appear like they're coming after them and doing something. You know what I mean?
When the Securities Exchange Commission or the SEC finds Goldman Sachs.
Oh, yeah.
It looks like they're doing something. Goldman Sachs faced $600 million. So what? Now what happens is Freddie Mac, Fannie Mae, SEC has more operating money to continue regulating, so to speak, and hiring people, and their budget is secure.
Well, and it's
no one's been punished as a result.
And nobody's been punished, but Bank of America, it's interesting what they've done. They've completely changed their approach where they're basically they're almost out of the mortgage lending world as far as they're not going to allow, be a correspondent lender where other people can sell their loans to them or place mortgage products with them. They're only going to
that anymore.
Right, they're just going to actually take their own customers, and if they want to give a mortgage to their own customer, then they'll do that. So, and they're selling off basically all the servicing rights to about another, I want to say 2 million other mortgages, which is worth another $306 billion. So they're really distancing themselves between a lot of their problematic home loans. They don't want to be tied to any of that. It's like them trying to revamp their image. Like we're really not in the mortgage business anymore. They were the same. They were the same people.
Those loans to Ryan, the Fed will buy those, so they will get stopped up in the market somehow by the Fed. And it's not like, because that would be a massive change to the market if your number one lender gets out.
Well, and plus, the thing that we haven't mentioned yet, which is another good reason for the Fed to manipulate interest rates, if you keep interest rates low, obviously in most areas what it's doing is it's increasing the demand for properties, which is obviously driving up the price of homes. Well, a lot of banks have bad assets on the books, right? So the longer that they can keep these interest rates low, and the more they can raise the demand for these homes and drive up real estate prices.
They can trickle them out. They don't have to dump them on the market all at once.
Precisely. So they're actually able to help banks recoup a lot of their losses. So then you don't have the FDIC having to bail out every single bank. It's just it's just maybe 1 or 2 or 3 or 4 a month instead of 15, 20 a month.
And that's why, Ryan, what you're saying, there's no way, and we'll make our predictions now, I'm sure you agree, that the Fed is going to do anything to stop the purchases in 2013, unless they've got some other grand scheme to keep interest rates low, because the whole name of this game is to keep interest rates low for an extended period. They said they were going to do that through 2015. They need to do that to keep the U.S. borrowing costs low, and they also need to do that to make sure that the banks can continue at a very slow pace to get rid of their bad mortgages onto the market.
Yeah, and there's absolutely no private appetite for these mortgage-backed securities, so I 100% agree. The Fed will keep interest rates low for an extended period of time, I would say through 2014 at this point, because they have to continue to keep, kick the can down the road and make things look just as peachy as they're leading on to. We're coming up on a break, guys. When we come back, we're going to dive into our predictions for 2003. Stay right there.